Hello everyone, Assalamu alaikum. Welcome to first HBL Insights call. I'm Humaira Kamar. I'm looking after HBL's research and equities. In these calls, we will be sharing our views on recent economic and market trends. Today, I have with me Faizan Ahmed, who looks after rates trading and derivatives, and Risha Moyuddin, HBL's global treasurer. In today's call, we will be discussing State Bank's recent monetary policy announcement, in which the central bank kept policy rate unchanged, as was expected. In the policy statement, the State Bank talked about improvement in overall economic growth and employment. They see GDP growth to improve to 3% in this fiscal year 21, compared to their previous estimate of 1 to 2% growth. The policy statement talks about improvement in LSM activity, and they also talked about some leading economic indicators such as cement offtake, auto sales, petroleum offtake, which has shown considerable improvement in the previous months. If we look at current account data, so we are seeing second consecutive deficit in the current account numbers, which shows that the economic activity is back on track and imports are improving. So overall, we see positive outlook on the growth side. However, we might see some interruptions coming from the third wave of COVID, and then the situation might seem a bit more challenging on the growth side. Faizan, what are your thoughts on the MPC?
Thank you, Omera, for bringing me into this conversation. The decision was widely expected from a market standpoint. Interesting to note is that they have largely kept the language of forward guidance intact, and they have brought into the fray the near-term inflation outlook and any new tax measures which the government may introduce as far as the upcoming budget is concerned. First things first, State Bank has actually acknowledged that the next few inflation outturns are likely to be on the higher side, such that the fiscal year average will now be closer to the upper band of the previously announced 7 to 9% expectation of State Bank. Having said that, the overall tone of the monetary policy statement suggests that this time around, State Bank is likely to be reactive rather than being proactive. So they may let the inflation take its normal course and then on maybe decide whether and with respect to the quantum of the rate hike as far as monetary policy is concerned. Risha, what are your views?
Thanks, Faizan. So if I'm to look through the MPC for today, it does look a little bit slightly less dovish than the one they put out in January. So for example, today they mentioned that inflation will probably remain towards the upper end of the 7 to 9% inflation target, whereas in January they mentioned that it will remain within the 7 to 9%. So slight subtle change in emphasis. Last time round they mentioned that inflation expectations remain well anchored. Now they're talking about inflation expectations being anchored. So these are subtle shifts that central banks use to convey their sense of where monetary policy will head in the near future. Now, the overall sense I get is that this is a central bank that does want to be accommodative, and they are pointing to the fact that growth is still, although higher than what they expected earlier, still tracking only around 3%. They're talking about the fact that there's still spare capacity in the economy. So overall, as I said, it's a balanced view. But really, the one overriding factor is the fact that the pandemic will throw up a lot of uncertainty, as it did last year. So just one point I want to add here is that last year, a lot of producers expected demand to remain very low, and this was across the globe. So in terms of auto manufacturers and other manufacturers of consumer goods and so on, reduced their production orders. But what happened is that slump in demand didn't really occur to the same extent. So what happened is there were bottlenecks in terms of industrial goods, pointing to containers, for example, which have doubled in price over the past few months, just points to the fact that there are supply shortages in certain key areas of the global supply chain that could lead to a cost push inflationary pressure if and when, as we expect, the pandemic does ease off. So a lot of uncertainty, watch this space, and good luck. Thank you.